Welcome, it's the Crypto Sniper short update. So, how's things progressed? Pretty nicely. So that upside HVF made its target, had a little pullback over here, joined with a pink coat, very short pause at the smaller structures target. Remember, this is the great value of when you stack setups within setups across multiple time frames. So that is a small setup on your right shoulder where you had very much the inverted version over there on the left shoulder. That symmetry that I referred to as a reminder, what happens there often happens there in the future. So we are more primed to expect that. So we were looking for an upside HVF. We were getting excited at this point. We were early. It got a slam down on that first touch of the 43, which was the neckline here. The first touch over there, armpit 2 and armpit 1. So there you go. But progress overnight has been steady, consistent, and onwards and upwards. So you're now sitting at 46,578 on Bitcoin. Here's where it starts to get kind of interesting. If it's to continue broadly being upside bias, this is your big level that you're going to want to watch, where you might get a blow off and then a subsequent pullback. So the possibility could be you run it. There's a couple of ways it plays out, typically price behavior. There's this, let's go the uber bullish way. It blows off through 47.5 so much that it just runs the 48.6. Then you get a much longer period of progress decay, like we had said would happen when you ran the 47.5. You got all the way down, you got a wind up, you got down, you got a small little rising wedge, and then you got another leg down. That's quite a reasonable all the way down to 38-ish pullback. So that's the most bullish one. You run through the 47.5 and the 48.6. That's in one go, so it has such momentum, but that'll be kind of blow-offy, and you might be prone to have similar style wicks to that one that I've just drawn a line alongside when you get to the 47.5. You may have a couple of goes at the 47.5 like this one did. Bop, initial pop down, and whoop, initial pop down, and then finally a blow off, making, marginally higher highs, and then eventually you get into that squeezy that we were seeing and watching and saying that's probably going to eventualize to the downside. So that's a bit of narrative and a bit of potential price behavior framing for the most bullish option. Anyone will say the most bullish option is just a straight line up all the way to 100,000. Inside normal constraints, the probability spectrum. I'm not talking about potentially possible, but at 0.001%. So obviously that you could just rip forever, and you could even, so I suppose, and this one is not as outlandish as just ripping to $1 million, but you could even have follow through a momentum. This would be, I suppose, if the pink one is an A for your exam, and is an exceedingly good outcome. The blue one would be an A+. That would just be ripped to the 50. And that would be exceptional, because then you'd also take out the key round number. But I think we're going to be winding up for that one. So we've got those two really bullish cases. One, a blow off through the target. That's the target of the inverted head and shoulder, the 48,610, and the A star, which is the supreme one, which would actually take you to 50. Now, deep down, I don't want it to run the 49. I would prefer it to stay under the 49, but I'm quite concerned that the 48,610 target and that 49 high are super close, and you generally do overperform to a target. So there's only really about $389 for it to turn around in to not make a higher high. And if it is to make a higher high and it does go a very extreme spike, then the 50 does become a possibility, and then the rejection there will occur. But those are the bullish scenarios of what comes next. The more sedate version of the ongoing upside is we get some degree of tenuousness prior to the 47.5, and we do some degree of winding up to run the 47.5 like this. That can stretch out the duration to target. Don't forget, we only triggered at this point here on the neckline That's of the inverted head and shoulders, and the triggering of the HVF was just a little bit before. Beauty of HVF method, getting you into trades earlier, squeezing the stop. That's your stop there. On a normal, this is the value, and let's just sidebar here because there's a learning here for you. So when you watch these videos, we appreciate likes and subscribes, but the real goal of me is there's an element of learning, and what can I impart to you that is informative, that makes you better, so that you can analyze that and see what does he mean with patterns within patterns and structures like this, and why is it useful? Why is it useful? If you just had the reversal, that's the pink draw structure, your stop loss is at the low of the right shoulder. In other words, if it went up, started to go, and then smashed down there, that is your loss point, and the closure for your trade, where assuming there's some leverage in there, is there. Obviously, investment you can elect to hodl, but that's not long run what we're about. If you get a fail, that's the failure point. Now that, when you look at our current structure on the lower time frame, that was just our low one on an upside HVF. In fact, the optimization of the HVF performing alongside with the inverted head and shoulder. Now that adds an extra component that has to perform, but generally, not universally. Sometimes the smaller pattern can perform, and then you can get a deeper washout lower, even making the shoulder lower, but generally not likely. So because they both are implying upside, and because the one is triggering the other, if you have the smaller, medium-sized domino falling over and it's hitting the larger domino, generally if it's weighted right and it's hitting it right, you also tip over the larger domino. Now it's much easier to do that, and you get better risk management. How tight can I squeeze the entry to the stop point? Yes, you of course increase probability of failure when you do that, but can you do it to a much lesser extent than the expansion that you get on your risk reward? So how much of the probability of outcome are you reducing versus how much are you expanding your risk reward ratio? Now, as you can see right now, as we sit in a very, and this is the mathematics of thought I want you guys to have, because it's actually numbers. Trading comes down to numbers. How many times are you accurate? And you can be very successful on a very low accuracy percentage, providing you are always chasing extended risk runs with very high risk reward trades. Broadly, that is our doctrine, which is why we kind of often get comments like this. Sorry, all of these don't prove anything. Andy's predictions are all wrong. Nothing comes to fruition. So you'll get a comment like that because you're not always being right. The difference is not rightness, it's making money. If I want to be right, you can just FOMO chase things that are already dominantly running. But that's a terrible trade strategy. That's momentum chasing, and that's what retail, in the absence of method, ends up doing. So what we discuss here is, how much have I reduced the probability of outcome? We refer to that as a pout score, when I get in a little earlier on that up move. But instead of the stop loss being over here, which is the trade you would be in on the inverted head and shoulder. In fact, you would only get in on the neckline, so you get that. And I'm just going to highlight this box. Have a look with me over here. So this is, as I go, this is the focus of our community, our method, our training, and our teaching. And I'm giving you little free tidbits here, and you'll either appreciate or you won't. The mathematics of building wealth is, what's the risk versus the reward? And can you logically sometimes add a tiny bit more risk that reduces your probability of outcome? And everyone fears the unknown, that it's usually overpriced, that actually it blows your reward up significantly further. So if you entered on just the pattern, that is the inverted head and shoulders, armpit 1, there's your inverted head, armpit 2, there's your right shoulder, your stop would have been down here. That's your loss in the red, and you would be looking at, that's not quite accurate, sorry, let me just correct, because it's now crept above the target. You would be looking at, I would imagine, just under 3. That would be your closure, 2.92. So almost 3. Not quite 3 in terms of what you would get. That is trading the inverted head and shoulder to its potential target. Now, if you got in that tiny bit earlier, by the way, we also do early entry. So I'm giving you the worst entry, what we refer to as our just-in-time entry on this particular structure. When we have many patterns stacked upon other patterns, we often do early entries to really blow out the risk reward. The key thing is when you are getting different time frames of price behavior that are all endorsing an impulsive fast move away from your entry. Listen to what I say. These words are kind of important, and I'm going to, super online. Here's the thing. Everyone always goes, here's the thing. I'm getting bugged with that because it's almost like the cliche now. So I'm not going to say, here's the thing, although I've now said it 4 or 5 times. But I'm trying to underline a marking learning point. Look into the eyes. Look into the eyes. Listen to me here. When you can get multiple patterns that are all indicating the same thing across time frames. So you're getting it on the lower time frame and then on the bigger. So the time frame for this inverted head and shoulder is a H4. When we just look at the pattern view of just the upside HVF, that is the right shoulder, we're right down to an hourly pattern. You're getting endorsement for your views at different fractal and the larger time frame generally. Don't forget the macro bull scenario, that since we did the inverted head and shoulder on the much bigger time frame, that was the 25K neckline with the targets that were associated to that we are generally macro bull. So we're stacking our biases with the bull trend. Now we have a little corner of price behavior and we have 2 patterns. Now, sometimes we've done this right down to having patterns nestled within each other that we have 3 and even 4. And most people never trade like this. Now, what I've drawn for you here is the difference. Can you see that we were at 2.92 on just the one pattern, the bigger pattern, the H4 inverted head and shoulder pattern? Now, when I take you into the fractal that is the upside HVF here and the triggering event, assuming you got the last moment just-in-time entry with the stop there, your return is 9.12. So what you actually have is a greater by more than 3x. That is a 3x plus. Can you see that? That's a 3x plus on the normal pattern trader who's just taken one time frame take. When you understand that, now understand I've taken more risk. I've got in a tiny bit earlier. It's not huge, but it makes a massive difference because it takes some of the risk away and adds it to the profit. So not only are you squeezing the risk, but you're also getting a little bit earlier, more profit. But here's the other aspect, and I'm not going to say here's the thing, even though I'm reminding you that it's here's the thing. So here's the other aspect that makes it even more significant in gain. So you're thinking, okay, Francis, you've shown me a way that I might get 3 times more. All right. But what if you're trading on that there leverage and you're allowing $1,000 stop loss? So do the maths with me on this and understand what we're talking about. If you do $1,000 stop loss, $1,000, and I had a certain amount of distance I could lose. So $1,000, but it is a different, this is now, I'm going back to just the inverted head and shoulder. So this number here in blue is the risk reward of the inverted head and shoulder. That's the 2.92. That's the one pattern. This is the 2 patterns, the 9.12, which is over 3x. Okay, so just recapping so I don't lose you. And this is where people get lost and they don't see this. Understanding the mathematics of trading. If you are going with the other one, so I'm going to redraw it. This is the trade idea. Back down to there, below that. And the entry is a little bit later. So that has to come a little bit more down. It's below it. And the reward gets that little bit less. You see those small moves. I'm getting a slightly different value. I might have drawn this one a bit too far. There it's about 2.8. So I'm not getting it exactly the previous number, but it's there or thereabouts. So you're getting in at 43,575 and your loss point is the low here, but you've got to leave a little bit of tick room. If it just equaled it, you want to stay in the trade. So it has to run it. Make it run the low. The low is 41,884. So look up at the low. So look with me up there, pointing up. You can see the L, 41,884. We're doing everything on Binance. So under this 43,575, I'm writing 41,844. 41,844. Now we need to subtract those two. And you're going to get approximately $2,000 minus it's 300, sort of 275. We'll do the maths for you. So this is really important. Some guys get bored when you start doing anything that's slightly bit mathematical. It's not long and it's going to be over soon. This is super important because what the answer you'll see me get for you here is you're suddenly going to realize it's not 3x that I'm gaining. That's just the difference in risk reward. Where am I taking you and why should you listen while someone does basic mathematics? Because I'm going to illustrate the value of just an additional smaller pattern and taking a tiny bit more risk on your probability of outcome. It reduces slightly, but the extra juice makes it worth your while. Now you can even split your trade and just trade the bigger pattern on half your loss on $500 and risk $500 on the tighter version. But I'm going to show you the two options. Not a split option, and you have that extra idea for you that you can play with. So 43,575, and this is the focus of understanding of HVF traders in our community. Links below, you know the usual story. 1731. Now, if I show you that number and I'm saying I'm allowed to lose $1,000, I'm going to cheat, and let's say you're reasonably flush. You're prepared to lose 1731 on this trade. Okay, not $1,000. And in fact, let's not do that. Let's stay with $1,000. I'm going to divide, I'm going to invert that number. So we're going to keep it simple and times it by 1,000. Whoops, I times it by 10,000. So I need to divide by 10. So the amount, you can't trade $1 because you're going to lose $1,731. Yeah. So let's just write that 1731 before everybody gets lost. So it's 1,731. There's your difference between the two numbers. You can't trade $1, otherwise you're going to lose 1731. And in fact, 731 is quite close to 2,000. So you're almost on 50 cents. And what did you get when we divided it? How much can you trade? 50 cents per point. 57 cents. 0.7 cents per point. So size on this trade is 57 cents per point. Okay, so it's 0.57. Now I'm going to be kind to this trade and I'm going to round it up just not to have too big a per point, too big a number per point on your leverage trade. That's how much you can lose to lose $1,000 to your stop. Yeah, you have a higher probability of outcome because you've got more fat for the market to pull back into, but it reduced your risk reward quite substantially. So now I'm going to take you to how much money you make on that particular trade. If you are 0.58 per point, how much you're getting in at 43,575. Where's our target? 48,610. It's this purple number up here. So follow this, 48,610. So we now have to deduct 43,575. This is the gain that you will make, the number of points, and we're going to multiply that by 58 cents. So you're following what I'm doing. Now you can see that's 5,000, which is good because it's 43 to 48. And in actual fact, you've got another $35 as well because the 610 is bigger than the 575. So it's 3,000 plus 35. So you're making 3035 points. Do you see that? 3035 points equals 3035 points. And the key wow moment you're about to get is when I do the other option for the slightly reduced probability of outcome. So that's 335 points. And we're going to, while we're still in full flow with the 57.7 on the calculator, I'll use the same number, it's already typed in, times 3035 35. This is how much you make on that trade. unsurprisingly, you're going to get, I want to just do that maths again, in fact, just to double test. Let's do it with 5.8 times 3035. Yeah, we're getting 1760. So you make, for that additional, for your leverage on that at 58 points, you're going to make 1760. You're going to go from 43,575 to 48,610. That is 3,000 points. To lose only 1,000 down to your stop, that was 41,844. You're 1731 that you lose. You're trading 58 a point. This is your money management exercise. So you're going to end up with that part of your leverage trade delivering 3,035 points times by the 58 cents. And that gave you a duff number. I said, no, it's not a duff number, it's 1760. So your return, let's go in pink, will be 1760, right? 1760, 1760. So you're all thinking you know the answer now on what the good trade is going to do. I'm calling it the good trade. Remember, it's a lower possibility of outcome. You have pinched your risk quite a bit. You've also got in slightly earlier, and that slight bit there makes a massive difference, guys. It makes a massive difference because you're nicking and you're stealing pips and points that are going from risk of loss to your future. It's kind of like a football match. You let in 2 soft goals, or the rival lets in 2 soft goals. You know, you've got to score 3 to get back. If you let in 2 soft goals, they let in 2, you're already winning by a 2-goal margin. So we're sitting here, and again, it's slightly changed. We got 9.12 last time. Now we're getting 8 points. I'm getting some minor variations, but we'll stick with the original numbers, 9.12. So where's the low here? So we're now going to do the same sum. Where's the low here? The low. Look at the top number for me. 42788. So it is higher than the 41844. That small difference is 42788. Let's check it one more time. We're going to that low, and your stop will be placed possibly a tick or 2 below, but give or take, we're going to take everything from the chart on both examples. 42788. Look at the low again, 42788. Entry was there, the RH3. What is the high of that? 43399. You see, it's $175, $76 earlier. That's not a huge amount, but you nicked from there, and you've nicked from there, and you've reduced risk on both sides and added it back in. It's a doubler effect into the reward. So 42788, let's check that number one more time. 43399, I seem to recall it. There you go, 43399. So we do the same mathematics that I did in blue for this one. 43399. Yes? Everyone's still with me, crypto kings? This is crypto traders and even investors don't understand the financial mathematics of money management. You must, in advance, already have a place where you accept you're wrong. That is a stop loss. That is hard-coded. You're not even watching the screen. The order is in and it's closed. Done. And your entry can often be put in advance if you know the level and the market takes you in. You don't even have to be watching. You could be sleeping. Part of this trade, I've been asleep. Okay. So the difference between these numbers, it sounds like that classic, make money while you sleep. Yep. But in some ways it is. It can be that. So we look at that difference. The difference, the squeeze difference on risk has changed immensely. You saw it here. It was 1731. You see where I'm pointing with that? It was 1731. What is it now? So we trust our trusty calculator so that there's no monkey business, and you can follow these numbers. 43,399 minus the 42,788. Great. Now we're going to be risking the exact same $1,000. And I'm going to be showing you how much more you will have made, not just because of the increased risk reward, but your sizing for the same loss is going to be significantly bigger because you're on 611 instead of 1731 risk. Can you see that risk has dropped? Not by a half, it's dropped by 2/3. from 1731. If I triple 600, I'm at about 1800. So you can see it's about 35% of what the other one is. So we're going to write that number down so you can remember this. 611. 611. There you go. $611 is your risk. Instead of what we had over here, 1731. So what is your, call it your pound or dollar risk per point going to be now for the same $1,000 loss? That was the profit of the inverted head and shoulder only trade at the end of the day on 58 pound per point. What is the profit on this trade using both patterns, where the smaller pattern helps the triggering of the larger pattern, and the probability of outcome only comes marginally back because they're both suggesting upside moves, and importantly in a breakout way where you have fast moving momentum away from your stop that protects you for the fact that you've got that stop super tight, that only goes with a volatility constriction where price behavior has compressed. This is the foundational basis of everything we do. If you can understand this, you're going to be making major quantum leaps in your ability to move forward. So I now have a different sum. I now have to say how much for $1,000 loss, how much am I in on 600? So I go 1,000 divide 611, and you can see this number is going to be bigger than $1 per point. It's actually 1.63666. Let's go with the rounding and call it 164, like we did with the other. So the pound per point, or the dollar per point, is 1.64 per point. Now also, you will also note that the per point, the gain has gone up. It's not 3035. It's slightly larger too. So I've moved from being 58 cents, below 60 cents per point in size, to being almost 2.5 times that size. And I'm getting more than 3 times on the RRR. So now you're getting a multiple on a multiple. Yeah. So you're now getting a multiple on a multiple. And this is so important for people to understand the value of multiplying your way to wealth, not adding your way to wealth, with the benefit of low time frame technical analysis within the larger time frame setups. This is why we first look for a great macro setup, then we look for a medium time frame setup within that, and then it's the only time we watch low time frames. It's the only time we drop and we look for fractals, the key gifts. And we've become specialists at spotting setups and price behavior because we observe it. It's the only thing we do. We keep looking for a very specific thing. So we notice traits and behavior. That is the uniqueness of the community. So 1.64 a pound per point. Now what is the gain? Well, the entry is lower. It's 43,399. It's not 43,575. Okay. The target remains the same. That's the only number that hasn't shifted. So we now we put in the target, in you go, 48,610, 48,610. This is on this exchange. It's kind of 611, but anyway, we'd use 610 there, so we'll use it here because it's a little bit of sense, and you would typically expect a small overrun, but we're not going to get too brassy. So here we go, 46. Now apologies, let's clear that, start again. 48,610 minus the entry of 43,399. Getting it? 5,211 points. That can't be right. Let's check it again. I made a mistake here, guys. I said 3,000, that was 5,000. Some of you have been shouting at your screen. Okay, well done for spotting that, and that means that calculation is wrong. So I'm going to quick do a correction because that affects that. That was a bad. That should have said 5. Whoops, that's a percentage sign. 5. Accept the correction, please, in good faith. That was a mistake. So 5,000 times, so we're going to go back and work. I thought that 1760 was too wrong. I checked it, double checked it at the time. How can you only make $1760? So 0.58 times 5035 equals 2920. Great stuff. So we've corrected that. 2920. And that is also dollars on a dollar per pound point basis. So that was wrong. And we cross him out. 2,920. Okay, so we go back to comparing what this one is going to do, and we got to. That's why we were getting 5,000, and I was wondering how can it be 5,000 when the other one was only 3. I know it's good. We got that risk squeeze, but it's not that good. Okay, so minus 48,610. We're getting back onto track here, and there you go, 5,211. So it's about 175 points better to the upside. It's significantly better to the risk side that has given you a far greater size. So you go down to 5,211 is your total gain. 5,211. This is on a successful points gained. And now we have to multiply that 5,211 times by, and this is the key moment where that extra size times by 1.64 equals. Can you see the difference between 2,920, and I'm sure you all can, it's a kind of rhetorical question, 2,920 instead of 8,546. 8,546. So 8,546, and we'll leave it there, is the additional gain that you have got from this. And in terms of pound per point, you are significantly higher. You're getting the points plus almost 65% more, while on this one, you were getting just over half for the amount of points because you were only just over half a pound a point. So divide that now by the 2,920, and you can see that that's crept up. It's crept up because this was showing only 2.8 risk reward, 8.83, which is actually less. The other one was 2.92. This is a bigger multiple. So you are essentially 3x in return, in total return, but in actual fact, the risk reward ratios were less than that. We had 2.92, and then we had 8.83. So we do 8.83 divide 2.91. In fact, we didn't get that. We got 2.8 something the second time. I think I trusted more. 8.83 divide 2.84. So you can see that 3.5 times is a substantial additional gain in return because of boosted reward, increased sizing of position. Increased sizing of position makes a massive, massive difference to everything that you've got. And as a result, the fact that you will make more money, and you've got to ask yourself, you've increased the risk slightly. However, if both patterns typically have, by theory of HVF method and some traditional technical analysis, get a high, low volatility leads to an expansive break, how much extra risk have I taken now that you've got the expansive move away from your entry, so your entry is there, how much extra risk of that and then bouncing here and still going on to target versus it doing this and not running the deeper stop? I would say if it's doing one, it's almost certainly likely to do the other. There's a very small additional cost in probability of outcome. That is the understanding the possibilities of what the market could do. After it's broken so strongly, I would say both these are rather low. Listen, someone can stand up and say Bitcoin's going to zero, it can be prominent or start a lawsuit or something, and the markets can crash. But in that event, they're probably both going to fail if it's a big enough event. After the market has moved this quickly away from the entry, you've actually taken that slight amount of risk. Most of that risk is in the beginning. Once you've had the impulsive move away, that risk falls away to almost the same. Almost the same. It's a bit like I'm playing a football match. My team that I've backed is 3-0 up. What are the odds of them losing? And your team is 5-0 up. We're both probably going to win that game, and there's 20 minutes left in the match. The fact that you are safer because you have that deeper stop is actually a moot point. You've overpaid for that extra security of those additional 2 goals in a football match. The 3-0 is, on all balance of probabilities, going to do the job for you. And more importantly, it's taken you from a position size of 58 cents. Let's do that again. 58 cents to 164, which is almost double. 58 cents divide 1.64. That's a crazy number. I didn't do 0.68. Oh, calculators and digits. 1.64 divide 0.58 should be in and around 2.82. So not only are you getting 3 times the reward on the risk reward basis, but you are earning in reward 2.8 times the size per point had you been more conservative. So the cost of that conservatism, or that non-understanding fractals and just looking at one time frame and not looking to optimize trades. And this is part of it's quite deep into our intermediate theory and even some of our more advanced elements, the multiplier way to growth. So we talk about introducing, HVF method introduced, that's the beginning. And we cover a lot of the basics. HVF intermediate, and then HVF advanced. There's 3 separate modules, and you're getting a little bit of an insight into some of the elements of the more advanced side of that. So 3 times the risk reward, 2.82 times the size on each point. And the fact is, the probability of outcome is carried by both patterns. If the smaller one fails, it's quite possible the larger one fails anyway. If the smaller one triggers and runs to target, it's quite likely that you're well on your way on the bigger one too. So there is an overlap because they're both suggesting the same thing to a degree, only the larger one obviously projects further. So you're using the risk management of the lowest time frame, which is the tightest, and you're stacking that risk on top of the risk of the bigger pattern, but you're getting the reward of the bigger pattern. And that is what we call multiplying our way to wealth. And this is what's happening on Bitcoin right now. And I would assess that the likelihood is higher in our favor that we get there from here than we run there. But you can't be ridiculous and say 100%, 90%. It's over 50, because of how far you've advanced. But there can be pullbacks, and it's a probability-ometer. Any form of pullback, it will drop a little bit, it will go up. So you're sitting with your 0 to 100, and I want you to start thinking of probabilities of outcome. And you have this thing as the price behavior comes. But if it's a good winding up, it pulls back and it does another mini little HVF, you can actually add new positions with the same big target of the macro pattern on a smaller setup again, because you are confident and you can build your way into a trade. So if that did that, and that, your probability would have dropped slightly on the down leg. It would have crept back up on the smaller leg. But this I'm drawing real small. You could do that. You could actually put new entries here and trade it all the way up to the bigger target, which this one won't suggest. But then you must have the risk reward on the smaller pattern. You can't put it down here, because then you're actually trading a trade where you're getting a unit of 1 of reward, but you're prepared to take 3 of risk. So in other words, you're taking a separate idea, a small fractal idea, and saying, we're expecting you to go, so we're adding a little bit of extra component. Now, if you stack too many of these, some of these can fail on the smaller side, so you could trade down here for a deeper move and sit here and then end up setting up another bigger target. You would lose on that one little pig out idea. And we introduce pigging out into our advanced area of our content that is very professionally recorded. Click the link below if you want to find out more. And we discuss this all the time on the trading. And then that could actually boost the target of the inverted head and shoulders. So all our trades, if we get new information, we could actually extend the rewards on all our existing trades that we entered back down there if we think this is a good quality pattern that can inform, and we call that bonus. So then you end up with your additional 3x risk reward, which gets pushed to 3.5x, and you'll multiply your way to wealth with your smaller pattern that has now made you go from 58 cents a point to 164 a point, now getting an additional target bonus and a little top up in the sizing, because you can keep maintaining your loss at $1,000. That is how you can do it. And you can, what we call the way, you can subsidize your way into late entries. So we have the just-in-time entry, we have early entries, and we have late entries for the macro idea of the inverted head and shoulder. But that comes in gifts that get given to you because markets staircase their way up. And when they consolidate, they will say, hey, we're going sideways, we need a rest, here's another opportunity. And if you started with getting in really early with a stop here, and let's say you are buying in here, by then that stop has moved higher. So you've reduced your risk. That means you're no longer on risk for $1,000. You might be only on risk for $800. You can risk another $200 on getting in late up top here. This is really sophisticated money management utilizing the gift of HVF method. And we've given you a little insight of what's going on. And as the guy pointed out, we're always wrong and nothing what we say comes, because we don't have to be right that often. We don't have to be that right that often. Because once you've got a winner, we wring its neck completely, all the way on and up. The most vulnerable point is this key point at the beginning. The key point at the beginning, right there. An event such as this, where you resisted there, if you didn't have your stop under here or under here, you would have been washed out. So you early, you're in here. So if you had bought early somewhere here, you would have gone slightly underwater here on this hammer. And you would be sitting in this trade. That's okay, providing you have a hard stop that is sized and that is part or proportion of your $1,000. Okay, anyway, that was quite a technical update. The mathematics of trading and understanding, multiplying your way to wealth, utilizing multiple time frames of analysis, 360-degree analysis across markets, and recognizing that we actually got HVF structure on across the board in crypto, and that it pointed to a likelihood of a lot of money coming in that gave us additional confidence to trade this Bitcoin with a little bit extra and to push the risk out with the fractal in the right shoulder in the bigger thing. I hope you've enjoyed it. I hope you found it useful. Smash a like, share it, and all the usual stuff people say. Most of you will do it anyway, and we appreciate you for that. Thank you, and bye-bye.